Namaste friends. In part 1, we explore 5 powerful companies benefiting from India's rapidly expanding data center ecosystem, and the response from all of you was absolutely incredible. First of all, thank you from the bottom of my heart for the overwhelming response to part 1 of our data center series. Today we are back with 4 more fascinating businesses connected to one of India's biggest long-term growth opportunities. Remember, this is not a recommendation video. This is purely about learning, understanding business and becoming better informed investor. So let's dive in. Today we are going to study 4 more companies that are participating in India's digital infrastructure revolution. Each business model, different strengths and distinct opportunities. But before we begin, I want to reiterate something extremely important. Your financial well-being matters far more than views or subscribers. Therefore, please note this video is strictly for educational and awareness purposes. I am not SEBI registered analyst. Nothing discussed in this video should be considered as investment advice, stock recommendation or solicitation to invest. Please consult a qualified financial advisor before making any investment decision. Because remember, as an informed investor is always a better investor. So with that said, let's learn together. Friends, before discussing the companies, let's understand why this sector is attracting so much attention globally. Because if you understand the big picture, understanding the businesses become much easier. According to the CBRE India Alternate Sectors Outlook 2026 report, India's total data center capacity is expected to grow by approximately 30% year on year during 2026 alone. 500 megawatt of additional capacity expected to be added. Think about that for a moment. This is not an incremental growth. This is a transformational growth. Even more importantly, India is projected to attract over USD 54 billion worth of data center investment commitments during this calendar year. Now let's connect this to the global AI revolution. Recently, Nvidia, the company powering much of today's artificial intelligence infrastructure, announced its Q1 FY26 earnings. Their data center revenue reached an astonishing USD 75.2 billion in just one quarter, representing a 9.2% year-on-year increase. Nvidia CEO Jensen Huang described it as an extraordinary quarter. And what happened immediately afterwards? Several Indian companies connected directly or indirectly to AI infrastructure witnessed significant positive market movement. Now, does that mean we chase momentum? Absolutely not, because this story is much bigger than short-term market reactions. Friend, this is a potentially a decade-long structural trend driven by artificial intelligence adoption, cloud computing growth, 5G expansion, digital transformation initiatives, India's rapidly increasing internet penetration. And today we will examine 4 companies positioned at different points across this value chain. Let's meet them. Now let's begin with our first company. Company number 1, HFCL Limited. Friends, our first company is one that many investors have heard about but perhaps haven't fully understood. HFCL Limited, NSE symbol HFCL, formerly known as Himachal Futuristic Communications Limited. The company was established in 1987. For decades, HFCL was primarily recognized as one of India's leading optical fiber cable manufacturers. But over the last few years, something interesting has been happening. The company has been quietly transforming itself into a much broader digital infrastructure player. And here is a simple way to understand its role. Every data center requires optical fiber connectivity, 5G network infrastructure, high-speed communication systems, secure networking solution. HFCL operates across all these critical segments. In many ways, HFCL is helping build the infrastructure behind India's digital infrastructure. Now let's look at the some numbers. As of September 2025, HFCL reported an order book of approximately rupees 9,981 crore. That's nearly rupees 10,000 crore worth of confirmed business visibility. During Q4 FY 2026, the company delivered a remarkable improvement in profitability. Profit after tax increased by more than 300% compared to the corresponding quarter of the previous year. Operating cash flows also improved significantly, turning strongly positive after being negative in the previous year. But that's not all. HFCL has also secured several important government related opportunities. The company emerged among the lowest bidders for Bharat Net Phase 3, a project value at over rupees 8,100 crore aimed at expanding high speed internet connectivity across rural India. Additionally, HFCL secured an advance work order from BSNL worth rupees 2,501 crore on the defense front. The company has been allotted 1,000 acres in Andhra Pradesh for establishing a dedicated defense manufacturing special economic zone. Management has guided that defense revenues could potentially reach rupees 500 crore with the possibility of doubling over subsequent years. HFCL has also raised fresh capital through a qualified institutional placement, reflecting institutional participation and confidence in the company's future plans. Now let's discuss what makes HFCL educationally interesting. Key strengths: low debt profile. The company's debt to equity ratio stands at approximately 0.21, indicating a relatively conservative leverage position. Strong innovation focus. HFCL operates dedicated R&D centers of excellence in Gurgaon and Bengaluru, supporting product development and technological advancement. Growing international presence. Export continue expanding across markets including Europe, Africa and the Middle East. However, as always, it is equally important to understand the risks, because investing is not about hearing only positive stories. It's about understanding the complete picture. Important factors to monitor. Premium of valuation. The company's price to earning ratio remains significantly above the industry average, indicating that markets have already factored in substantial future growth expectation. The critical question becomes, can the company execute and deliver on this expectation? Shareholding pledge. Promoter shareholding pledge remains around 54%, making it an important metric for investors to track over the time. Revenue cyclicality. During FY25, revenue experienced some decline due to weaknesses in the optical fiber cable demand cycle. Although signs of recovery are emerging, investors should monitor whether this improvement sustains. Educational takeaway. HFCL presents an interesting case study of a legacy business reinventing itself. The company is diversifying beyond traditional telecom infrastructure into areas such as 5G defense, manufacturing and digital connectivity solutions. Its sizable order book offers revenue visibility. Diversification may help reduce dependence on single business segment. However, transformation stories also involve execution risk and valuation require careful assessment. For investors who believe in India's long-term digital infrastructure growth story, HFCL remains a company worth studying, understanding and monitoring closely. India's homegrown AI infrastructure champion. Friends, if HFCL is helping build the roads of India's digital future, then our next company is building the engines powering that future. Meet Netweb Technologies India Limited. NSE symbol Netweb, established in 1999. Netweb Technologies has emerged as one of India's leading providers of high performance computing solutions. In simple terms, they design, manufacture and deploy supercomputers, AI servers, GPU clusters, high performance computing infrastructure. And here is something that genuinely makes me proud as an Indian. Netweb's supercomputers have featured 15 times across 3 entries in the prestigious top 500 global supercomputer rankings. Let that sink in for a moment. And an Indian company competing on the global stage among the world's most powerful computing system. Now, why does this matter in the data center story? because the next generation of data centers is no longer just about storing information, it's about processing enormous volumes of data, training AI modules. Now let's look at the numbers. The company's recently announced FY 2026 performance was remarkable. FY 2026 performance highlights: revenue grew approximately 92% year on year, nearly doubling in just 1 year. Profit after tax increased by approximately 80% year on year. Earnings per share rose from 20.25 to 36.30. The company remains completely debt free, maintaining a net cash position on its balance sheet. Revenue from AI systems grew by 112% year on year during FY25, with strong momentum continuing into FY26. The board recommended a dividend of Rs 3 per share for FY26. Show revenue and PAT growth charts. Friends, let's pause here. Revenue growth of 92%, profit growth of 80%, debt-free balance sheet, dividend payment. These are extraordinary numbers, especially during period when many technology companies globally face challenges. Industry analysts tracking the company expects revenue CAGR of approximately 29% over the next 2 years, compared to roughly 11% growth of the broader Asian technology sectors. Now let's discuss what makes Netweb educationally compelling. Key strengths: pure play AI infrastructure. Business unlike diversified companies, Netweb offers focused exposure to AI computing infrastructure without legacy business distractions. Fortress-like balance sheet. Zero debt means minimal financial risk and substantial operational flexibility. Global recognition. Repeated appearances in the top 500 supercomputer rankings reinforce technological credibility. Operational maturity. The recent deployment of SAP S/4HANA reflects investments in strengthening the internal system and scalability. However, no business is perfect, and thoughtful investors always evaluate both opportunities and risks. Important factors to monitor: premium valuation. The company trades at significantly higher price to earnings multiples relative to peers. This indicates that markets are already factoring in substantial future growth expectations. Limited margin of safety. Some analysts suggest that current market prices exceed their estimated fair values based on discounted cash flow models. This means investors should carefully consider valuation alongside business quality. Promoter holding trends. Promoter shareholding has seen some moderation in recent quarters, making it an area worth tracking over time. Educational takeaway. Netweb technology represents a world-class business operating within one of the fastest growing sectors globally. The growth trajectory appears real. The financial performance has been exceptional. The technological capabilities have earned international recognition. But investing teaches us an important lesson. Even great businesses require disciplined entry points. A wonderful company purchased at an unreasonable valuation may still disappoint investors. Successful investing is often about combining quality with patience. Netweb is certainly a company worth keeping on your watch list and studying in depth. When real estate meets the digital future, friends, this may be the most fascinating transformation story in today's entire list, because it involves a company that spent more than 5 decades building success in one industry and is now positioning itself to participate in a different growth opportunity. Meet Anant. NSE symbol Anant, founded in 1969. Anant has been a well-established real estate developer in the NCR region for over 55 years. The company has developed residential townships, IT parks, hotels, commercial projects, study businesses, predictable growth. Through its wholly owned subsidiary, Anant Raj Cloud Private Limited, the company is actively developing a data center and cloud infrastructure capabilities. Importantly, these developments leverage strategically located land assets, including 220 acres on Golf Course Extension Road, 100 acres in Delhi prime location with substantial long-term strategic value. The company has also signed a landmark memorandum of understanding with the Haryana government, committing investments of approximately Rs 25,000 crore. towards data center and cloud services development, and their expansion roadmap is ambitious. Data center capacity expansion plans: 63 megawatt IT load capacity targeted by December 2000, expansion to 117 megawatt by FY28, long-term target of 357 megawatt by FY32. To provide some perspective, a 357 megawatt footprint represents a meaningful scale, placing the company among significant players within the sector. Now let's examine the financial performance. FY 2026 performance highlights: revenue reached rupees 2512 crore, growing approximately 22% year on year. Profit after tax stood at rupees 557 crore, representing approximately 31% growth year on year. PAT margin exceeded 22%, an impressive level for the sector. The company has delivered 5 consecutive years of uninterrupted revenue growth. 10-year revenue CAGR stands at approximately 15.8%, reflecting long-term consistency. But here is another important development that many market participants may be overlooking. The board has proposed a demerger, separating the traditional real estate business from the data center business into two independently listed entities. Why is this significant? Because separate entities often allow investors to evaluate each business independently. This increased clarity can sometimes lead to more appropriate market valuations aligned with each business's specific growth profile. Now let's discuss areas that require careful monitoring. Important factors to monitor: large capital expenditure requirements. Scaling data center operations will require substantial investment of approximately rupees 20,000 to rupees 25,000 crore. This represents a significant commitment for a mid-sized company. Execution clarity: some analysts have highlighted minor inconsistencies in management commentary regarding capacity expansion timelines during different quarterly interactions. Execution discipline will therefore remain important. Return on equity: current ROE of approximately 10% remains moderate. However, this metric could improve meaningfully as higher margin data center operations scale. Real estate cyclicality: the underlying real estate business remains exposed to economic cycles and NCR market dynamics. Educational takeaway: Anant represents a rare business combination, a profitable cash generating legacy business funding its own transition into a potentially high growth future opportunity. The land bank represents a hidden strategic asset. The data center business offers future growth potential. The proposed demerger could become a value unlocking event. For investors who appreciate long transformation and systematic wealth creation through disciplined investing approaches, Anant Raj certainly deserves a serious study and deeper understanding. Friends, I intentionally saved this company for the very end because sometimes the most interesting investment stories are not the ones dominating headlines. They are the businesses quietly creating value in corners of the market that most investors have not been discovered yet. Meet Aeroflex Industries Limited, NSE symbol Aeroflex. Founded in 1993 and headquartered in Mumbai, Aeroflex manufactures stainless steels, flexible metal hoses and assemblies. Now I know that what some of you may be thinking: hose pipes, metal tubes, what does this have to do with data centers? Stay with me for the next few minutes because this is where the story gets truly interesting. Let's first understand and where Aeroflex products are used. Their products serve multiple critical industries: aerospace and defense, where precision and reliability are absolutely essential; oil and gas refineries, enabling safe transportation of hazardous materials; pharmaceuticals, supporting sterility and high purity application; semiconductor manufacturing, requiring ultra clean processing environments; hydrogen energy, one of the emerging energy themes of the future; electric vehicles, particularly in thermal management systems; and now data centers, liquid cooling solutions. We will come back to this shortly. Another fascinating aspect of this business is its product diversity. Aeroflex currently offers approximately 2,938 product SKUs. Nearly 3,000 different product variation. Why is this important? Because such a broad product portfolio creates a significant competitive advantage. This is not something competitors can replicate overnight. Developing this range requires years of engineering expertise, manufacturing capabilities, certification, and customer relationships. Now let's examine the financial performance, and honestly the numbers are impressive. Key financial highlights: 5-year profit after tax CAGR 50.3%. The company has compounded profits at over 50% annually for 5 consecutive years. Return on equity 18.6%, indicating efficient utilization of shareholder capital. PAT margin 12.5%, healthy profitability for manufacturing business. Net debt negative, meaning the company holds more cash than debt on its balance sheet. Quarter 4 FY26 PAT growth approximately 57% year on year. Revenue growth approximately 38% year on year. Promoter holding 65.5%, reflecting significant promoter ownership and alignment. Let's pause and appreciate these numbers. 50% profit CAGR, debt-free status, 18.6% return on equity, 38% revenue growth, 65.5 promoter ownership. Friends, finding this combination in a small to mid-cap business is genuinely uncommon. Now let's discuss important factors to monitor. Small cap risk. As a smaller company, Aeroflex may experience higher volatility and lower liquidity compared to larger businesses. Valuation consideration. The stock has delivered substantial returns over the past years. Consequently, valuation may not be as attractive as they were 12 to 18 months ago. Global trade factors. Management indicated that US tariff related developments led to the temporary shipment deferments from certain American customers. Importantly, they clarify that there were no order cancellation. Low dividend payout. Dividend payout remains around 7% of profits, reflecting management's preference to reinvest earnings into future growth. While this may support expansion, income-focused investors should take note. Educational takeaway. Aeroflex demonstrates many characteristics often associated with quality compounders: strong returns on capital, healthy margins, debt-free operations, a diversified product portfolio creating a competitive advantage, and now an emerging growth opportunity through data centers, liquid cooling solutions. Friends, let me conclude with something I strongly believe in and something that has guided me throughout my journey as a financial professional. Investing is not about finding the next hot stock, it's not about chasing momentum, and it's certainly not about acting on tips. True investing is about understanding businesses deeply, understanding their strengths, recognizing their risk, evaluating their growth potential, and then making informed decisions aligned with your own financial goals and risk appetite. The 4 companies we explore today, HFCL, Netweb Technologies, Anant and Aeroflex Industries, are not recommendations. They are case studies. Each represents a different business model, a different stage of growth, a different risk reward profile, and each tells a unique story about India's ongoing digital transformation. Your responsibility as a thoughtful investor is to study these businesses, understand their fundamentals, discuss them with qualified financial professionals, and determine whether any of them align with your long-term financial plan. And remember this, whether it's through mutual fund SIPs or direct equity investing, consistency and patience often matter far more than trying to perfectly time the market. If you found value in today's research-driven discussion, please like this video, share it with someone interested in understanding India's data center opportunity. Subscribe to Finova Solutions so you never miss our educational content, and if you have not already watched part 1 of this data center series, you will find the link in the description below. We cover 5 additional companies with the same depth of analysis and research. I am Shankar Pawar from Finova Solutions, your partner in financial education and wealth planning. Until next time, invest with knowledge, invest with discipline, invest for long term. Jai Hind. See you in the next video.